Many analysts and brokerage houses have come out lately and said that the next 10 years in the stock market returns will not be as good as the last 10 years. And guys, after looking at a lot of data, I could not agree more. In fact, in many past videos, you will find me stating this exact same thing. We've had an amazing 10-year run in the stock market, but history points out what could happen next when starting at these current valuation levels. So let's see what happened in the last 10 years. This chart right here is QQQ on the top and SPY on the bottom, total returns. What does that mean? That includes the dividends paid along the way. And over the last 10 years, you took 5.4x your money in QQQ and 3.5 times your money in SPY. For QQQ, that's 18.5% per year. And for SPY, S&P 500, 13.5% per year. Again, this includes dividends. Now, what is that? Guys, that's an insane amount of money. If you go back, and I'll show you right here, this is my stock market to GDP ratio. These historical returns do not include dividends, but the best return ever over a 10-year period was 16%. You add in dividends for the S&P, roughly 2 to 3% extra over time. That's 18 or 19%. The worst was negative 7.19%. Okay, guys, the NASDAQ was pretty much at this level. And that 16% return came on massive lows in the stock market. Remember, the more you pay, the less your return is going to be. And every investment is the present value of all future cash flows. In the long run, the fundamentals of the market are going to drive the value. In the short run, it's popularity. Now, 10 years ago, we were still coming off of the great financial crisis. There was still a lot of people timid about investing. And that's when the real bull market started. And that's why we've seen such a big return. Going back to 1929, we're actually 112% overvalued. Not 112% ratio, 112% overvalued. And here are the returns based on undervaluation and overvaluation. And you know what? What a shock. The more undervalued are, the bigger your returns. As you get more and more fair valued and overvalued, what happens to your returns? They decline. It just makes logical sense. The more you pay for something, the less your return is going to be. Now the question becomes, can we expect decent returns in the future? Well, I don't know. Now I want everybody to keep in mind, I took the data from Shiller at Yale and went back to 1871. And since then, the annualized return on the S&P 500, not including dividends, was 4.8% per year, okay? If you add in dividends, the average dividend over 150 years is 4.3%. That's a high dividend yield, by the way, for a total of 9.1% per year. That's annualized. Now, if you take all the data going back and you just take the average return, it's about 10% per year, between 10 and 10.2% per year. That's the average. Now remember, annualized and average are different. The annualized about 9%, the average is about 10% to 10.2%. So when I look at these returns and I sit there and see that in the last 10 years, the S&P has done 13.5% and the NASDAQ's done 18.5%, it just makes me go, are things just too good? Now, what are reasons why returns would be a lot better in the future than the last 10 years? What would be those reasons? It's pretty obvious. You have massive GDP growth. You have companies doing amazingly well. Really though, the best returns have always come off of bad times. Because when bad times occur, people sell, prices drop, and those drops in prices usually over-exaggerate the actual potential in the future. The same thing happens on the upside. When things are rosy and great and bull market, everything's awesome, people pay more than what they should pay. And what happens in subsequent returns? They drop. So what do some of these analysts say? Well, Goldman is projecting 3% a year in the next decade. That would rank in the bottom decile of comparable periods in the last century. It also puts the odds that stock will fail to outpace inflation at about 33%. Now, Goldman's forecast, in fairness, is far below the consensus on Wall Street. But I want to ask you a question. Why do you think Wall Street has such a rosy consensus? Guys, it's their job. They're trying to tell people, give us your money to manage. If they really went out there and said, give us your money to manage, and by the way, returns are going to be terrible, why would you give them the money? You can get 4.2% on a 90-day treasury. According to their analysis of the publicly available capital markets of 21 asset managers, the other 10-year forecasts for the S&P range from a low of 4.4 to a high of 7.4, with the average being about 6%. Now again though, going back to these valuations, on the stock market to GDP ratio, we're 112% overvalued. Now a very common thing I hear about the stock market GDP ratio is it doesn't matter anymore because so much money is made overseas. Well, it's not as much as people believe. What I always tell people is, remember, we always want to look at data, and I have the same bias, I'm sure. But I then sit there and say, okay, let's take the 10-year cyclically adjusted PE ratio. What that does is it takes the last 10 years of earnings on the S&P, brings it to today. It doesn't care where the earnings were made, overseas, outer space, here in the United States. It says the companies in the S&P, how much they make. Let's bring it to today's dollars and today's number. And our current PE is about 37 on a 10-year basis, which is 115% overvalued. The historical average is 17.1. That's incredible. Both of these metrics have the fair value around 2,700 or 2,800 on the S&P. Now, does that mean it's going to go there? Not necessarily. We've been overvalued for a very long time, and markets value, some fundamentals keep getting better. I mean, look at this. Our stock market GDP ratio is based on the GDP. And how has GDP gone in the last 6 years? Up over almost 50%. That's an insane number. When you have GDP growth, that's one of the benefits of inflation. It drives up that GDP number so high that companies eventually catch up and people are making more money, they're paying more for products, their costs go higher, etc. It's a vicious cycle. Does that mean we should be rooting on inflation? I'm not here to say that. But what I am here to say is valuations are still at levels that are hard to stomach. If you look back at the stock market to GDP ratio, back at the tech bubble, which a lot of people still consider the worst bubble ever, we were at overvaluations of 55%, half of where we are today, less than half of where we are today. And look at the returns over the next 10 years. Without dividends, we were negative 4.4. That's hard pill to swallow. But keep in mind, in 1996, 97, valuations were still a little bit rich compared to that previous history. But then compared to now, they're actually pretty reasonable and stocks did what they were supposed to do. So I'm not here to be a futster because I don't believe in trying to time the market. All you should care about is where are stocks going to be when I retire? And the longer outlook you have to that, the better you're going to do. So the most common question I get is, well, Paul, valuations are so high. Shouldn't I sell? Should I just wait to buy stocks? Should I hold cash? Guys, I'm not here to tell you the right answer. There's no way I can tell you in a video. However, history shows that that's not the right idea. History shows that you need a dollar cost average and a low cost ETFs. In fact, so much that I've actually announced in other videos that dollar cost averaging and a low cost ETFs will be probably a big part of what I do, because I had a big thing to sit there and say, I don't really need to make 15% returns. I don't need to crush it. What I need to do is invest when it makes sense. Now, does that mean I'm buying SPY, QQQ, and SCHD today? No, but you shouldn't mimic me because my situation is different than yours, and your situation might be different than somebody else who also is watching this video. Remember what this means. Stock market values over the long run, but this is where prices go. We are, according to history, higher than the average price. But I can see reasons why we should have a premium paid now for companies in the future. We have higher returns on invested capital. You can invest a lot less money to get a higher return. But at the end of the day, it's going to be relative to your opportunity cost. And right now, we look at rates and where they are. You need to sit there and say, what premium do you need to get in the next 10 years in the S&P to justify buying the S&P versus a 10-year treasury? Because usually during very high valuation metrics like we're at today, stocks will underperform the corresponding treasury notes from the US government for that same time period. When will it happen? We have no idea. Valuations can stay sky high for a very long time. But finally, when valuations do matter, they will matter with a vengeance. We already saw the market start to break down from the outside. The cannabis, the EV, all the junk stocks that all went to zero. But now we're stuck with this Magnificent Seven. And this Magnificent Seven is doing so well. And nobody can imagine a world in which these companies don't do well. But I want to remind you, look at Tesla. Tesla hit an all-time high of 415, and since then has not recovered, yet the business revenue has almost doubled, the profit has more than doubled, and the stock at one point was down over 75%. And it's still down 40% or so from its all-time high. That's a big difference for a company that's up that much in terms of revenue and profit. Why? Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And I have some other great news for you guys. I love talking about QQQ because not many people on YouTube talk about it. QQQ is the NASDAQ 100 ETF. Great ETF. And guess what? In 2000, from its peak to its bottom, it dropped 83%. But if you dollar cost average from the very top of the market then until now, you'd have made 13.5% return on your money versus the S&P of 10.5% doing the exact same thing of dollar cost averaging. But the hard part about investing is sitting and doing nothing, watching a stock fall 83%, watching an index fall 83%. But this is the time you need to be buying. And if you don't want to sit there and guess what's the right time to buy, awesome. Just start dollar cost averaging today. It's a great way to get in. And if you dollar cost average with diligence, you're going to do very well. I want to shift your focus from being worried about the next 10 years, but being aware of it, to protecting yourself, to going on the offensive and taking advantage of the opportunity that you will see likely in the next 10 years. No one in this world is coming to save you. And the people around you are going to be scared, and they will make emotionally charged investing mistakes. And they will justify that with what's going on in the world. You can't afford to stop investing. And you should never interrupt your investments from compounding. That means at times watching stocks fall very, very hard and very fast. It's more important than ever that you need to surround yourself with like-minded people who are calm and excited to buy stocks at cheaper prices. In our community, on red days, it is amazing the excitement that occurs in the community. Another red day. This is awesome. I wish stocks would fall more. Isn't that the mentality you wish you'd have? And if you already have it, awesome. But it's not easy to do that. You shouldn't be alone in doing this. Understand what you're buying when you buy stock, and surround yourself with people who are headed in the direction that you want to go. So the question is, are you going to join the community and surround yourself with those like-minded investors? Click the link in the description below, or go to everythingmoney.com/sign up. And if you want to watch the video on the 3 ETFs that will never sell, watch our next video. Thank you for your time.